Hello, this is Jordan, and this video is being recorded on Tuesday, May 17th, 2022. Thank you so much for joining me today. And today in this video, I am going to discuss and analyze the potential bearish case for gold. It's important to look at things from all angles and understand what drives bull markets and bear markets in precious metals. And so we can assess these cases and just analyze which ones might have merit. In my opinion, most of them do not. But let's get right into it. Oh, and if you haven't already, make sure you subscribe to the channel. I'll have a lot of great content coming, more great interviews, more videos, some educational videos. So if you already haven't, do me a favor, hit the subscribe button. I really appreciate your support. Okay, enough of that. Let's get into it. So thinking about the bear case for gold, I mean, usually these things come up. You know, you have the 1929 or 2008 collapse. I mean, that's really popular on Twitter. You have the deflationists and guys who call that. In my opinion, a lot of that is a grift. I mean, that's a lane that they're in. That's their brand. Huge deflationary crash. Pick a low number. Look, Robert Prechter was the first to talk about that in the late 90s, and we know how that worked out with respect to gold. But anyway, secondly, then you have the guys who are saying, no, the Fed isn't going to shift policy. They're going to have to tighten a lot more. You know, inflation is 8%. They're going to tighten way much more than you think, like they did like he did from 79 to 81 or so. So there is that case. And then there's also the other case, which to me, this is actually my favorite bear case. I think this makes the most sense historically, is you get an economic rebound, money goes into stocks because things are going good, and as a result, you can have higher real interest rates. I mean, most of the time. And Gary Tanashian talks about how gold is counter-cyclical, and this is a great example. When things get better, you can have higher real interest rates. And so that's the other bear case for gold. And, you know, at the end of this video, I'll talk about which one I prefer or which one I favor at the current juncture if there is a bearish case for gold. Now I'm going to get into a couple of charts here. And the first is with regard to the Fed's really going to have to tighten a lot more. It's important to understand the Fed, well, there's a couple things here. We're not going to have Volcker-style tightening. There's just way too much debt in the system. So that's impossible at the current point. Now, maybe the argument is, well, I think the Fed's going to go to 3% or 3.5%, and the S&P has to come down a lot more to the low 3,000s. That maybe that's reasonable. But the important takeaway here is that the Fed follows the market. So this is what I've said in my writings and in videos. The Fed is going to follow the market, and that's why this chart is important. I've talked about this recently. Look at the 10-year yield there. Look at the blue arrows. The 10-year yield there, it's in the second row. Look at the blue arrows. That shows the peaks in the 10-year yield, and then those two blue lines show the last Fed hike in that cycle, and then the first cut after that. And the red shows the bottom in gold. So fundamentally, I think the case is quite clear for gold right now. Fed stops hiking. They're going to cut not that far after or ease in some other manner. And gold is really going to perform after that. But, we're not at that point yet. I think there has to be some more tightening, but not a lot more. Maybe that's the disagreement with the people who have more of a bearish case. But circling back, it all comes back to the market. So the Fed is going to follow the market. And that's why watching the 10-year yield, also the 2-year yield, but the 10-year yield here, it's really a leading indicator. Because in most cases, the 10-year yield is going to peak and decline first before the 2-year. I mean, we've seen it in so many cycles where the Fed is still hiking, but the 10-year's already rolled over. Then the yield curve goes to be inverted, and then you're in real trouble. And of course, the yield curve are already inverted. It's probably going to reinvert again at some point. But this is what we have to look for. If the 10-year yield, I think it's probably already peaked. I mean, everybody has been super bearish on bonds. If you look at the sentiment indicators and all of that, all the money has already bet on higher interest rates, lower bond prices. So, we're talking about multi-decade extremes. So I don't think it's that risky of a call to say that bond yields are probably going to go lower, or at least the path of least resistance is lower. And so that's my point here. The Fed and a lot of people may think that they're able to tighten to 3% and that they're going to send stocks a lot lower with this tightening. But if you watch the market and you follow what's going on, things can change very quickly. And if the 10-year yield rolls over and declines, to the mid or low twos, we get to that point in the next month or two, then the Fed knows they can't hike that much more. So in my opinion, you have the June meeting, July meeting, then you have the September meeting. I don't think the market is going to allow them to tighten all the way to September. So I think it's somewhere between the July meeting and the September meeting, we are going to see that shift. And that's why these next two meetings, the Fed they're going to want to get 50 basis point hikes done. These next two meetings, they get to 2%, then they can shift course. Now, I want to point out one thing with this chart. You have the CRB there at the top, very similar chart with oil. The weightings in the CRB index are crap in my opinion, but it still matters. It's similar to oil. And look, the 10-year yield already made a double top and was coming down 2008. Remember everybody was concerned about deflation, there were signs of it even as oil was still rising. We did have a little bit of a lower high in gold after the March 2008 peak. So what I'm pointing out here is, waiting for oil to peak and roll over, that is going to be important. That's probably holding up the inflation hasn't peaked yet narrative, but the 10-year yield is more important. If the 10-year yield rolls over and oil is still going up, the market is still going to sense that the tide has turned with respect to inflation, and then eventually when oil peaks and rolls over, that's going to happen after the fact. So the 10-year yield as a turning point, more important than oil in the CRB in my opinion. And as we know, the 10-year yield rolls over, the Fed is going to have to stop hiking at that point and eventually ease. So more on that when I get to my concluding slide. But last chart here, we're looking at the last 20 years or so. We have the dollar, the real 5-year yield, and gold. And, we can see here, if we look at the declines in gold and then the corresponding increases in the real 5-year yield, that's really what drives precious metals. We already know that. And when you get into a 2008, 1929 type of situation, or even COVID, real yields will spike briefly. But when they spike, financial conditions are tightening, the Fed, they have to get in there and they have to ease everything because they can't let the tightening go to 1929 levels. So, yes, temporarily, that is a huge concern for precious metals when you're in that environment. But, the worst point for precious metals was, if we look historically, you had the early 80s. Remember, that came after a decade-long bull market. The Fed was tightening aggressively. The economy was recovering. So you had all these negatives, I should say, in that scenario. You had the Fed tightening. You had the economy rebounding. Real interest rates going through the roof. But and you had some similar things in the 2012 to 2015 period. Gold declined something based on this chart, I think 44% during that bear market, 36% when it really crashed. And, real interest rates were up, but, they didn't go up, that much. Or it was kind of a slow and steady rise. But at the time, remember, gold was coming out of a decade-long bull market. The stock market in 2009, look at where the CAPE was. The CAPE ratio, look at my article today. The CAPE ratio a couple months ago, it peaked almost at 40. The CAPE ratio, I believe in 2009, was like at 12 or 13 times. In 2011, the CAPE ratio at, when gold peaked, the CAPE ratio, I want to say, was like 17, 18. It was historically at a reasonable level. And by the way, gold broke down, the stock market broke. It made a 13-year multi-decade breakout. So, I mean, that was a case of, real interest rates are going higher. The economy is getting a little bit, wasn't great, but there was at least some economic improvement at that point. So, and that was 44% bear market, much worse than 2008. Lasted much, much longer. And, last thing about this recently, gold's down based on this chart, about 11% from the all-time high. The dollar's been going through the roof. Real yields have been rising. So gold has still been holding up really well. But I think, one bearish case, I think technically you could say, gold could come down to the 40-month moving average, which I have the weekly equivalent there that comes in right about 1,700. So I don't, know how much, what is that, 7-8% lower. This chart isn't to the minute accurate. But that is some potential downside for gold. I mean, maybe if you see some severe tightening for another month or two and the market goes really overboard, maybe you could get a move, a flash crash type of move below 1675. There are a few similarities to 2008. After the summer of 2008 when gold made a lower high, then it sold off pretty sharply, into that October bottom. But, if we get that kind of a move to, 1650 or 1700, from that type of sell-off into a low, I mean, gold, it can V-bottom after that point. So I think technically there is a bear case to make. And we're talking about, price, trend, intermarket analysis. We're not talking about Elliott wave counts or, this cycle low or there's this cycle. I mean, that stuff is subjective. It's just guessing. It doesn't mean anything. Remember, when you analyze you have to analyze the market. The problem I have with these cycles is you're looking at the cycle and then you're trying to fit the market to that. No, you just have to read the market and price and trend and that data. That's objective. So there is a potential, technical bearish case you could make. I just outlined it there. So I know this video is getting long. We all like short videos, but to kind of conclude, I mean, this, there's going to be this huge deflationary collapse. I mean, that scenario, we saw how fast the Fed acted in 2020, COVID. They overreacted massively. Okay, 2008, you had a 30% decline for 5 or 6 months. And, I mean, that was it, 1929. Look at gold stocks. They didn't, after they went down during the 1929 crash, and then they just went up. I mean, there weren't that many of them. So a deflationary crash is not the worst. I mean, it makes no sense. Yeah, we're going to have this huge crash and gold's going to go to 800 or 700, 900. It doesn't make any sense. I mean, you're not a serious person or analyst if you're talking about that because you haven't looked at everything. So, are we going to get Volcker-style tightening? Not really, because the Fed is going to follow the market. And inflation is going to come off. Not saying it's going to go to 2%, but looking at market indicators, inflation is probably going to come off. And, if we get a peak in oil and that rolls over at some point, then that'll be it. Everybody will be concerned about deflation and recession and no longer inflation. So we're not going to see Volcker-style tightening, but we will see a little bit more tightening, in my opinion. So I think that's reasonable, but no, we're not going to see Volcker-style tightening. And then the last one, we're not having an economic rebound. I mean, we have been seeing higher real rates, but that's temporary. We're not having an economic rebound. That is the worst case scenario for gold. It's not the 1929 or 2008. It's you have an economic rebound, and then you have higher real interest rates, like you had in the early 80s and like you had after 2011. And even, briefly for the last year. I mean, it was inflationary, but that's, historically, that's really the worst case. So in the early 80s, you have the worst of it. You had extreme tightening and higher real rates, and you had an economic rebound. Oh, and by the way, that came after gold went up. How much did gold go up? 25x or 23x? I forget. So it came after a 10-year bear market. Here and now, gold is at the same level as it was 11 years ago. Okay? So there's no similarity to 2012 or 2013. So I know there wasn't an easy answer, but I think that's the bearish case in the very short term. There is some technical concern with gold. We are going to see a little more tightening. That, I think, is the bearish case in the short term. However, I don't think it's going to have much of a shelf life. I mean, when things turn, they're going to turn pretty quickly. So keep watching the bond market and stay tuned, because it's going to get pretty exciting after the next couple months. Thank you so much for tuning in. Let me know what you think. Leave a comment. I really appreciate it, and look forward to publishing another video for you guys in the days ahead.